Picture this. You open your phone one morning in early August 2026, and there's a headline that makes almost no sense at first glance. The United States Treasury just helped bail out Japan's currency. Not a loan to a struggling ally, not disaster relief, a currency bailout for one of the wealthiest countries on Earth, using a mechanism most Americans have never heard of, for a total that adds up to somewhere around $67 billion. Once you combine what both governments actually spent, your first reaction is probably the same as mine was. Why? Why is the US government spending tens of billions of dollars propping up the Japanese yen while people back home are dealing with their own cost of living pressure? Is this actually about friendship, like officials claimed? Or is there something else going on? Something that has almost nothing to do with helping Japan and almost everything to do with protecting America's own finances? My name is Bobby, and this is The Wealth Insight, where we spend way too much time thinking about the invisible math behind decisions that get announced in a single, vague headline and then never properly explained. Today, we're breaking down exactly what happened with the yen bailout, the real numbers behind it, and the actual reason the US stepped in, which is a lot more self-interested than the official explanation makes it sound. If you've ever wondered how something like this connects back to your own wallet, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's start with the actual event, because most coverage of this buried the important details under vague language like currency intervention, which tells you almost nothing. On July 30th, 2026, Japan's finance ministry sold as much as $59 billion to buy back its own currency, at a moment when the yen had fallen to a 40-year low. That's not a typo. 40-year low. The yen had started the year trading around 156 to the dollar and had steadily weakened to 163 by late July. That may sound like a small technical shift if you're not familiar with currency markets, but a currency losing that much value that quickly is a genuine crisis signal. One that historically Japan has handled entirely on its own. Except this time it didn't. Tokyo and Washington confirmed they had acted together to support the yen, something the two countries hadn't done since 1998. Let that sink in for a second. This is the first time in nearly 3 decades that the United States has directly intervened to help prop up Japan's currency. That's not a routine event. That's a historically rare move. And when something that rare happens, there's always a bigger story underneath the official explanation. So how much did the US actually put in? Here's where it gets interesting, because the exact figure was never officially confirmed. A photograph of Treasury Secretary Scott Bessent's notepad, visible during a cabinet meeting, reportedly showed the figure buy Japanese yen $5 to $10 billion. Combine that with Japan's roughly $59 billion intervention, and you land in the range of $64 to $69 billion total, which is where that headline figure of roughly $67 billion comes from. It's not an exact confirmed number because governments rarely publish exact intervention totals in real time, but based on the reporting available, that's the realistic combined scale of this operation. Now here's the part that should genuinely surprise you. The US didn't just wire dollars to Japan to help them out. Reporting indicates the US Treasury sold off an undisclosed amount of euros and used those proceeds to purchase an equivalent amount of yen. Think about what that actually means. The Treasury didn't create new spending or dip into some emergency reserve, specifically earmarked for foreign aid. It swapped one foreign currency holding for another. It sold euros it already held and used that money to buy yen. This is a critical detail that almost nobody explaining this story bothered to mention. Clearly, because it completely changes how you should think about what bailing out Japan actually meant here. So why would the US government structure it that way? Why not just use dollars directly? This is where we get to the real reason behind this entire operation, and it has very little to do with friendship. With US interest rates already elevated and more government debt issuance coming, the United States could not afford to let Japan keep selling off its holdings of US Treasury bonds. Here's why that matters so much. Japan is one of the largest foreign holders of US government debt in the world. When a country's own currency is collapsing, one common response is to sell off foreign assets, including US Treasuries, to raise cash and defend the home currency. If Japan had kept doing that at scale, it would have added even more selling pressure to the US bond market, at a moment when the US is already borrowing enormous amounts of money and already dealing with elevated interest rates. In other words, if Japan had been forced to keep dumping US Treasuries to defend the yen, it could have pushed US borrowing costs even higher, right as the US government needs to borrow more, not less. So the United States found a way to help stabilize the yen without directly increasing its own debt issuance or borrowing costs by trading euros for yen instead of creating new dollar-denominated obligations. The Treasury protected its own borrowing, costs while simply swapping one currency, holding for another. And the actual loser in this exchange turned out to be the euro, which dropped more than 1% after the sell-off. This is the piece that gets lost in the "we're just helping our ally" framing. According to Treasury Secretary Bessent, the official justification was that an excessively weak yen threatened broader global currency stability and could trigger competitive devaluations from other countries trying to keep pace. That's a real and legitimate economic concern. But by assisting Japan directly, the United States may have been protecting its own bond market just as much as it was protecting Japan's currency. Both things can be true at once. The stated reason and the actual self-interested reason aren't mutually exclusive. And that's exactly why understanding the real mechanics matters so much more than just accepting the press release version of events. Now you might be thinking, Bobby, okay, but why is the yen collapsing in the first place? What actually caused this? And that's the right question. Because the answer connects directly to decisions the Federal Reserve has been making that most people don't realize ripple this far. The core driver is something called the interest rate differential, or more specifically, what's known as the carry trade. As long as U.S. interest rates remain substantially higher than Japanese interest rates, investors have a strong financial incentive to borrow money in yen, where it's cheap, and invested in higher-yielding assets elsewhere, typically dollar-denominated assets. This creates constant selling pressure on the yen because investors are continuously converting yen into dollars to chase better returns. Japan has kept its interest rates extremely low for years, while the U.S. has kept rates elevated to fight inflation. That gap is the engine driving the yen's collapse and currency intervention. Buying yen directly only treats the symptom. It doesn't fix the underlying interest rate gap causing the problem in the first place, which is exactly why analysts are skeptical this intervention will hold long-term without further support. There's also a second, quieter dimension to why the U.S. cared enough to get directly involved here, and it comes down to what a weak yen actually does to global trade. When the yen weakens, Japanese exports become cheaper for the rest of the world to buy, while American exports become comparatively more expensive. That shifts the trade balance in Japan's favor and puts pressure on American manufacturers and exporters competing in the same markets. A collapsing yen isn't just a Japanese problem contained within Japan's borders. It has real consequences for American businesses trying to compete globally, which gives the US Treasury a direct financial incentive to prevent things from spiraling further, well beyond simple diplomatic goodwill. So let's zoom out and ask the question that actually matters to you. Why should any of this affect how you think about your own finances? Here's the connection most people miss entirely. This intervention is a live example of something that happens constantly, quietly, in the background of the global financial system. And it's the same underlying force that eventually shows up in your mortgage rate, your savings account yield, and the price of things you buy that are manufactured overseas. Government debt levels, interest rate policy, and currency stability are not abstract concepts happening somewhere far away from your life. They are the invisible architecture behind nearly every financial decision you make. When a government has to structure a currency intervention, specifically to avoid increasing its own borrowing costs, that tells you something important about the constraints that government is actually operating under. Around this same period, U.S. 30-year borrowing costs hit their highest level since 2007, which is exactly the backdrop that made this creative currency swap structure necessary in the first place, rather than a simpler, more direct dollar-based intervention. When you see headlines about national debt, about interest rates, about the Federal Reserve, this is what that actually looks like in practice. It's not abstract. It's the exact mechanism shaping decisions being made in real time, with real consequences for currency values, trade balances, and eventually consumer prices. And here's the part that ties directly back to something we talk about constantly on this channel. Governments, just like households, are constantly making decisions to protect their own balance sheet, sometimes disguised behind language that sounds altruistic. Just like a company doesn't announce, "We're raising prices to protect our margins," a government doesn't typically announce, "We're intervening to protect our own borrowing costs." They announce, "We're helping our ally," or "We're protecting global financial stability," both of which can be genuinely true, while the self-interested motivation running underneath gets far less airtime. This isn't a criticism of the decision itself. Protecting the stability of your own bond market while helping stabilize a major ally's currency is, frankly, reasonable policy. The problem isn't the decision. It's the gap between the stated reason and the complete reason. And that gap is where the real financial literacy lesson lives. Every time you see a major financial or economic announcement, whether it's a corporate earnings call, a government policy shift, or an intervention like this one, there's almost always a stated reason and a fuller, more self-interested reasons sitting right underneath it. Learning to look for that second layer is a skill that pays off far beyond just understanding one currency intervention. So what should you actually take away from this? First, when a government intervenes to protect a foreign currency, always ask what happens to their own domestic financial position as a result. In this case, the US Treasury structured the entire operation specifically to avoid raising its own borrowing costs, which tells you interest, rates, and government debt levels were the real constraint driving the whole decision. Second, understand that currency intervention treats symptoms, not root causes. As long as the interest rate gap between the US and Japan remains wide, the underlying pressure on the yen doesn't actually go away. It just gets temporarily suppressed. Currency intervention can shift market psychology for days or weeks, but unless the underlying economic forces genuinely change, those gains often fade. Which is exactly what analysts have been watching happen in the weeks since this intervention took place. Third, and this is the big one, recognize that global interest rate decisions ripple into places you wouldn't expect. The Federal Reserve keeping rates elevated to fight inflation domestically has consequences that show up as a currency crisis on the other side of the planet, which then loops back around and shapes decisions about the US Treasury's own bond market. Nothing in the global financial system happens in isolation, and understanding these connections is what separates people who just react to headlines from people who actually understand what's driving their own financial environment. I want to leave you with this. The story wasn't really the US helped a friend in need. The real story is that two governments, both under real financial pressure, found a mutually beneficial way to solve two problems at once. One publicly stated, one quietly protected. That's not a scandal. That's how large-scale finance actually works, at the level of nations just as much as at the level of your own household budget. The people who understand money aren't the ones who take the press release at face value. They're the ones who ask what's actually happening underneath it. And once you start asking that question consistently, you'll notice this same pattern showing up everywhere. In corporate announcements, in government policy, and yes, in a $67 billion currency intervention that most people never fully understood. If this video helped you understand what actually happened with the yen bailout, make sure to smash that like button and subscribe to The Wealth Insight for more content that breaks down the real math behind the headlines nobody explains properly.